Hello again, everyone. This is Mike Paulenoff, mptrader.com, March 7th, 2010, with your weekly video chart update. All right, let's see if we can do this in about 10 minutes today. Two things I want to highlight first about last week: the People's Congress, the Chinese People's Congress. Information coming out of that meeting from the Chinese leadership suggested that monetary policy in China will remain accommodative, and fiscal policy will remain stimulative. And that is what the international markets wanted to hear. Number two was the reaction of the U.S. indices, stock indices, to the otherwise innocuous employment report. Nothing's really changed in the employment report, although the market was set up to react positively. Tuesday, Wednesday, and Thursday, the S&P consolidated in a high-level range, 1125, 1115, and then took off towards 1140 on Friday. And so the data, the fact that the data was not a disappointment, a big disappointment, led everyone to continue the trend that had been in place since early February. Okay, so having said that, I want to address the Chinese situation. What you see on the screen is the Chinese composite, the Shanghai composite, from the low in October of 08 to the high in August of 09, and then ever since August of 09, several months of sideways action. Now, when we look at it in a longer term or intermediate term perspective, what we see here is a big uptrend followed by a sideways consolidation. So we can look at this as a digestion period of this huge up move, which in effect becomes a bullish pennant type of pattern. However, the proportions are sort of interesting. This is a multi-month sideways bull flag, if it is that, and it's starting, for me, it's starting about back here in December, after a 6-month sideways stint. I was expecting it to break out, but no, it continues to coil. The longer it goes now, the more disproportional this big area becomes as relates to the up leg. So the Shanghai composite had better get on its horse and take off in order for it to extend the bull market. Otherwise, if it breaks down and it takes out the 200-day at 29.93, 29.93, and then retest the trend line at 29.25, you could end up having a very severe correction in China, and that would belie the message coming out of the Chinese meeting. Or it would confirm that the reason why the Chinese authorities are so accommodative and so stimulative is because the Chinese economy is not nearly as strong as everyone thinks it is or would like to believe it is. Okay, so let's keep this picture in mind. This is the Chinese composite. It has a very vulnerable aspect to it and needs to do some serious work on the upside to take off and extend its bull move. All right, so let's do this. Let's compare the Chinese composite with the S&P. Now, what I'm trying to identify here is Friday's action in both indices. This is the Thursday, Wednesday, Tuesday consolidation. Friday pops up on unemployment. The Chinese composite, before unemployment came out, was having its struggles. But the whole chart pattern here is different. It's heavy, it's vulnerable. The S&P, however, took off and is headed right back to its prior highs to test the January highs at approximately 1150. Now this picture suggests that money is coming into the S&P and is either stagnant or actually coming out of the Shanghai. This is to say, to me, that perhaps if the global economy is expanding, it is expanding because the U.S. economy will lead the way out, not the Chinese economy. Even though China is perceived to be the buyer of everything, natural resources, gold, grains, everything, the Shanghai composite is telling me something else. It's telling me it's tired, possibly tired, and needs a further period of rest, but not only rest, correction that will take this level out and have some meaningful downside. If that happens, what will happen with the S&P? Can the S&P continue higher with the Shanghai going down? My suspicion is no, but I have a feeling we're going to find out everything we need to know in the next few days, because this S&P is probably going to test its 1150 level. And if it breaks out and stays up here, consolidates like this, it's going to take off. And my suspicion is that the Shanghai will then make headway towards testing its key resistance at 3250. Now that's the bullish scenario, and that tells me that the U.S. is leading the recovery, the global recovery, not dragging it down. And that the U.S. consumer is going to come back with a vengeance, and employment's going to come back, and everything's going to be fantastic. Hard to believe? Yes. Unlikely? Yes. Probable? Based on this chart? We'll find out very soon. Because if we get rid of these lines that I just drew here in the bullish scenario, then what we will see is perhaps if the S&P fails around 1150 and then reverses, and then you have a series of down moves right off a double top, then the the Shanghai is probably going to go down. This S&P will double top and we'll be back in the soup again, because now the people who on this scenario, the people who are thinking a double dip have more reason to believe it. As of Friday's close, they don't. One more thing about the relationship. This is the relative strength chart on a weekly basis. Notice that the relative strength between the S&P divided by the Shanghai Composite. The breakout to the upside occurred because the S&P outperformed the Shanghai. We'll see if the Shanghai can catch up on Monday based on what the S&P did on Friday. If not, then this relationship will continue to move in terms of the benefit of the S&P, and more money will flow into the S&P, and more money and money will be flowing out of the Shanghai Composite. All right, so what does that mean for other markets? Real quickly, let's take a look. All right, the first one I want to put up is not the spider, which is what you see. It's the steel index, the SLX. All right, so this is the SLX, the steel ETF. The steel ETF. Let me get rid of these. The steel ETF rocketed last week, and it rocketed on the back of names such as X. This is X, U.S. Steel. Very bullish week. The AKS, a foreign holding corp, but steel, very bullish. STLD, another one that's bullish. So this isn't quite as bullish, okay? And Cleveland Cliffs, another name that's extremely bullish. That's the most bullish one of all. So you look at all this and you say, holy cow, steel's taking off. It must be a function of China. And maybe it is a function of China. But in order for that to really be true, the Shanghai Index Composite has to really make some headway to the upside. Number two is, you notice that this chart, this up move from the February low, has not made new highs yet. The S&P is going to try to make new highs probably Monday or Tuesday. And we'll have to see how the SLX performs. My suspicion is the XLX started an intermediate term correction in February, in January, and ended the first leg of it in February, like this. And now we're having a move that's retesting the high levels, and then it's going to fall apart again. And that, to me, will be a more accurate indication of not only China's influence on the natural resource areas, but also the fact that the United States economy is not as strong as the S&P chart will lead us to believe.